Hello and welcome to the Silver Log. It is the 5th of May 2011, and in this video I'm going to go over a different trend line that I may have shown before, but it's been a while. Go over different strategies for buying the bullion metal, or at least the one that I'm using, the methodology in which that I am using, as well as a few little topics for what's going on right now. The trend line connects the February lows with the breakout lows. Let's put in a straight line instead. And this is your trend line. By drawing a parallel line that finds the best resistance point. This one in here connects resistance followed by support. It's the best one on there. And by using this method of copying and pasting these trend lines and then putting it over top of a previous one like this, I'm able to get the same rate of increase, and just by drawing over the lines gives me a perfect parallel line every single time. This level was resistance, trying to become supported here, broke down, found a little bit of resistance, and then broke through it. No support found there, but of course, it was close. Next level. And this one in here, well, we're at support. We've pierced below it, but considering how, this pierced well more above this line than this has so far. So it takes a little bit, probably maybe down to about here to say you're in the middle part, it's no longer support anymore. Now you're really talking about moving to this one. Then we got this line in here. We'll see where this connects to. Maybe it might hit the top, might be close, might be off. We'll see. No, it's a hit. It hit the line pretty well, comes back down to support. And when I look at these, I think this is best, at least for myself, to be used as a measure for how well a bull or bear market is doing. In a bear market, you do it with the downtrend lines and you move lower. Bull market, as you see it here. This was the original level from February until the breakout, the top and the bottom, the range in which it traded within. Then you go through another, level 2, level 3, level 4, and we're really back at the top end of level 3 using this type of chart, of course. And when you have these increases, then what you want to look for is greater rates of ascent. And the trend lines, of course, there's this one. This one was the case before. You'll get back to that again. And now you might be able to draw another one in here. And really, in a sense, that will be the trend line to wherever it bottoms, if it's here or here. And that's if, of course, this trend line isn't tested. Okay, so that's enough about that trend line. Just wanted to point that out and go over a little bit on this market now. A lot of this, and a lot of people are talking about this. It's so obvious, the margins on the increases, the margin rates. That's what's bringing the market down. It's really obvious. And then you got Sprott selling silver. That's panic fear selling. If you've read Mike Maloney's book, you'd be thinking, did he not state to not get shaken out when moves like this happen? You look at the technical analysis long term. Look at we're obvious, well, the stages I showed before, and I'm stutter there, and there's just so many different reasons. It takes a long time to go through them. I went through many, I've missed many, which just shows the strength that this market has. In 2008, when the stock market was falling, interest rates were lowered and the stocks would go a little bit higher. But that didn't last. It's stuff they tried to do to fix things, and eventually it led to the bailouts, all the extra printing of money, which was kind of bullish for the silver market, I would think. And I sarcastically state kinda. Probably a better adjective might be used for that one. However, we're seeing the same sort of deal here. You have the interest or the margin rates going higher and higher. And from what I know of this, and I honestly don't know too much other than the basics of it, which is kind of enough for me, but in that of which you can't borrow as much. So just like interest rates, you can't goes from like 7%, 6.5. There's a ceiling at 0. So once you get to the point of a ceiling on the margin, that's you can't borrow anything. You can't go any deeper than that. And there were even times in the stock market when they lowered interest rates and the stock market still fell another couple hundred points. The same could potentially happen here where they do the same thing with margin rates and the market goes higher. Or the market stabilizes, doesn't sell off, and 3 days later goes higher. There's so many different things that could develop. The trend doesn't always stay. If it did, then we would never have ever broken this trend line. This never would have happened because the trend never changes. Obviously, the trend does change. So therefore, we see how we got this move lower. And imagine this. Let's look at this on a fundamental level. Let's assume that you were selling some sort of product and you were selling it here for 20 and people were buying it pretty big. And well, you realized I could sell more because I can't handle the traffic as it is. And I realized if I sell it maybe up to 25, 26, I'll sell less. I might make the same, might make a bit more, but it'll be easier work. Boom. And it keeps happening. They keep going higher. Now selling it for $50. And, well, gosh, dog darn it, they're still buying. And you're having problems with the accountant telling you your inventory is running in crucial situations of having stockouts. What should we do, boss? Uh, uh, let's put out some $10 coupons. $10 off. Let's do $10 off. We might go 15. We might have to go back to 5, but let's put $10 coupons out. That's the sanity I see within how the market's trading. These prices are the COMEX prices. You see these prices and it's what's been traded. It's not the real market. Even what you buy from any sort of dealer is based within this because they see the price at 40. They knew it was 50 before. They decide, well, I'm going to go 47 for these maples. I know I can buy them anytime I want for 44 or 45, and I'm ready to go. They're using the spot prices to determine that price. You don't see anyone stating, I want to sell for 120 an ounce. No. And then another question: how much is silver worth to you? If silver is worth $100 to you, you have a $60 coupon. If it's worth 200, it's a $160 coupon. If it's 80, 50% off. Congratulations. If it's worth 25, well, there's a $50 tax plus premiums on top. So if you got one of those fancy 75% off coupons, it's like 72 or something. But it's up to you if you want to cash it in or not within this time frame. Now, how I'm going to be using this market, and this is within the physical bullion, and I have found that buying from, well, here, everywhere pretty much, that it has worked better buying on dips. When you do that, your dollar cost average in a bull market slowly gets higher. But when you start buying at, say, the 16 level, that means in here your dollar cost average might be 18. In here, when the market's 30, your dollar cost average is 22. Now it's 24, 26, 20, or whatever, in that type of area within that type of range. So it makes it so it's still cheap but higher, and you'd rather have 1,000 units at a dollar cost average here at 30 something than say 500 units at a dollar cost average of 22. That's pretty much what I'm saying there. Alrighty, so the time to buy, well, I've said why I think this is a very strong bottom. Pretty much as strong as this one in here, if not stronger. And the next stronger one would be 31. We'll get to that in a second, but this would be the opportunity. Now, some people say you don't buy on weakness. You got a crash. Look at the trend line. It's severe. Come on. That's the trend line. The trend doesn't always stay. If it does, we're seeing $2 silver by the 4th of July. We'll just wait and see. I don't think that will happen. But when you're calling tops in here, you're doing it within the bull market. If I were to try and predict tops and bottoms, I would at least do it within the current trend. Meaning, when the market's going higher, look for opportunities on the way down where it's going to look to bottom. Is this one area? Yes, it is. Is it always support? No. It could very easily continue to crash through. It's done it in many markets. And if you try doing that in oil in 2008, what happened was your dollar cost average got a little lower but well below the market because the oil went from like 100 to 30. So you buy at 80, you buy at 60, you buy at a 50, or all those different increments. When you bought at what was the bottom again? 34. Well, whatever the bottom was, your average might be 60 something or 64 because you kept buying. Now that's obviously something you can't buy at a physical level. Now on a break below this 39 level, I would not buy a weakness again until 31. Actually 33. The range is 31 to 33 or in that area. So I'm going to do the level above it as the next area. Now that means what happens if it does something like this and never gets there and goes higher? You'll just never get it and you'll miss the boat. The answer is no, because it comes to whatever comes first. I buy here, which would be really Thursday of this week, which is tomorrow or today, depending, or yesterday, depending on when you're seeing it. Could be any day. But after that, it's again when it comes down to this previous resistance level. That was the Fibonacci level. That was 31.28. It could easily pierce above it, which is another reason for 33. And long term, $1.50 on 31 isn't much anyway. Therefore, if it does go like this, I'll switch it up to the shorter term time frame. Go to the hourly chart, look at the 5-day moving average. When it's showing a buy signal, that's when I buy. So it would be a buy at 39 and then again either on a hit at 33 or when the confirmation on the intermediate turns to newly bullish. Alrighty. Thank you so much for watching this video and have yourself a great day. Bye-bye.